I'm an Easy Equities user, as are a million other South Africans, and I've seen this thing on Easy Equities called Rise, RISE, and wasn't ever sure what it was about. Well, today I'm going to find out all about it, and so are you, because we've got Duane Gilbert. He's the guy with a tie who's going to be giving us some insight into exactly what Rise is and why it's yet another step for Easy in the democratization of investing in South Africa. Duane, I said the guy with a tie because the easy guys don't tend to wear ties that often. Did you have an interview with someone important?
Thanks, Alec. I think "guy with a tie" is a really great introduction. And to be quite frank, we catch a lot of flack with the Easy Equities guys about wearing ties and suits. But we're based in the institutional retirement fund space, and there's a certain standard you have to hold yourself to.
So I go, I will make a mention of that to Mr. Savage when I next have a conversation with him. But the Rise is on, as mentioned in the intro, on the Easy Equities website, RISE. Yeah. Now, I know I've done my research for this conversation, and it stands for Retirement Investment and Savings for Everyone, and you're the Chief Investment Officer. So there's lots we can talk about, and we are going to be talking about retirement and what's happening to the investment markets and to retirement savings in the past year. But just perhaps just unpack it a little more for us, what it is that you guys actually do.
Yeah. So retirement and investments and savings, retirement investments and savings for everyone is basically the retirement savings division of Easy Equities. So most of your listeners will know Easy Equities is a retail trading platform. So Rise is basically the division of the business where we manage retirement savings. So you as an employer or a decision maker in your firm can approach Rise through our website and actually join our umbrella fund and bring your retirement savings across to Rise.
So okay, you've lost me again. I'm of the age where people can retire. I'm not going to. Our retirement age at BizNews is 103. But officially in South Africa, the retirement age is what, 55?
Yeah, it was 65, I believe.
65. Okay. So if you, Easy Equities, your average age, if I remember correctly, is in the early 30s.
Yes, that's correct. We have a very young user base.
Okay. So these guys are now going to be encouraged to put money away for 30 years' time, which sounds like a heck of a long time when you're 30 years old. So how do you make it appealing for them? What's the incentive?
Yeah, well, really, I mean, we don't have any subsidized retirement in this country in a meaningful way. And, I think young people especially, they're waking up to the fact that, when you retire, you're responsible for your own finances. And I think a lot of people have parents who've reached retirement age and realize that, the burden falls onto them. And, they don't want to do the same for their kids as well. To pass the burden of their retirement onto their kids. So you'll be surprised. You might think that there isn't a strong savings culture in this sort of 20 to 30-year-old demographic, but it is quite strong.
Because of what they see.
Yeah, it's because of what they see. Like I said, I mean, they're taking care of their parents and they don't want to place the same kind of burden on their kids.
Especially black tax, I guess, is a big part of all of that. Just unpack that for us.
Sorry, could you repeat
what black tax is? Often one hears about it because there's so much unemployment in South Africa, usually in the black sector of the population, and young black guys tend to have to pay other people as well before they can start looking after themselves, which is something that's not always fully appreciated across.
Not always appreciated. I mean, to be honest, that's the first time I've heard the term, but I'm very familiar with the concept. You'll find that most working people my age tend to have, not only their parents to take care of, but a lot of them have unemployed or uneducated siblings who are either not earning a salary or earning a very small salary. And then on top of that, it's generally the burden of not having any family wealth to fall back on. So you have to build that own wealth for yourself and your kids, but at the same time, taking care of your parents and taking care of your siblings.
So start early, start saving early, and when you do get to retirement age, you will be in a position that nobody else has to take care of you. I suppose that's mainly the approach. But what about tax incentives? Are there still many of those in the retirement space?
Yeah, well, any contribution you make to your retirement savings is basically made on your pre-tax salary. So there's effectively a tax saving on your contributions. So it's not necessarily that you pay no tax, but the tax is deferred on your contributions till you till you retire and withdraw on the savings. And if anybody's sort of familiar with the time value of money, the further out you can push your tax burden, the better off you are.
Yeah. Okay. So you've given us the background to it. You did mention employers, and I guess we can't continue into the update of the past year of what happened to retirement funds without explaining how your business would be appealing to, say, BizNews. We've got 10 employees, 10 full-time employees. What would how would we find a use in what you have to offer?
All right. It's a great question. I would say you could connect with us through our website, www.rise.co.za. And effectively for larger employers, if you're a very big company, we could have a standalone solution. But for a smaller employer such as yourself, you could join our umbrella fund, the Easy Umbrella Retirement Fund. And, that will allow you to be part of a larger pool. Um, and effectively, your employees will contribute to their retirement savings. We'll manage those investments on their behalf. What I find is very appealing about Rise and why we're so well aligned with the rest of the group is that it's really this idea of bringing full transparency to the user. So, one thing, anybody I speak to who uses the Easy Equities platform, what they love about it is they can get onto the website and they can see um, they can see their balances, they can see how their stocks are moving, etc. And it's the same concept with Rise. You can see your investments, and we're one of the lowest cost providers around out there, and we have lower investment minimums than most of our competitors. So it's really about improving accessibility and transparency.
Yeah,
Not
and
to mention, obviously performance is cyclical, but at the moment we're top performing multi-manager.
oh, that's interesting. How does that
Yeah.
work when you say top
Yeah. Well,
performing? So I don't come to you and say, I want to put all this money into Meta and Amazon shares
yeah.
because I don't think you should be allowed to do that. But how does
Yeah.
all of that work?
So, yeah, I mean, just to make it clear, because I do like to boast about our performance, but at the same time, I like to make it very clear that we're not in the business of chasing performance. We managing retirement savings, and what we do for our clients is we match them with the appropriate levels of risk, and we put forward a diversified solution where it's a risk managed diversified solution that has multiple investment managers who we do very thorough due diligence on, and active asset allocation to sort of manage the risk in the portfolios. But I think ultimately, if you're controlling risk and markets go up and down, and if you can protect capital in those down markets and participate in the up markets, that is ultimately what you do, is you generate returns and reduce volatility for your clients.
So you looking for the best of breed in investment managers. The problem with that, I
Yes,
guess,
that's
is that
correct.
sometimes value is in favor, sometimes growth is in favor, sometimes bonds are in favor. How do you manage those conflicts?
Yes. So in terms of managing style risk, again, I think in investment markets, your only free lunch really is diversification. So you first and foremost you want to diversify styles, and that's not obviously a big part of it is diversifying growth and value and quality managers, but also you want to diversify against managers who have different areas of specialization. You find that some managers just gravitate towards the small and mid cap space, some gravitate towards resources, some gravitate toward rand hedges. And it's really about having a good, sensible, diversified blend. And you hope that those managers will outperform. And even if there's cyclicality in their performance, if you blend them together, that reduces volatility. And in terms of your asset allocation, we actively manage the asset allocation in our portfolios, which means that the asset allocation of our portfolios is firstly optimized and related to the members' risk profile. So younger members will have more riskier portfolios, older members will have de-risk portfolios. But when we go through periods of uncertainty, such as we are at the moment, we'll pull back on the risk, and that's really how we manage our portfolios.
That's an interesting concept. Now, like a 30-year-old self, I'm going back to when I was 30 years old. I want to save. Easy Equities makes it really easy. If I only have R1,000 a month to put away, I can spread it across a portfolio of the stocks I like. I can also then put money into a retirement savings plan. But my question, I guess, is: are you guys cheaper than others? I recall a guy selling me a retirement annuity when I think I was 22 years old. I don't know where it is,
Yeah.
somewhere in Liberty. And that retirement annuity, he made a bundle out of my investment into a retirement annuity. It was a ridiculous amount of money when I finally worked out what commission he was earning.
Yeah.
So what about the costs on your side?
I think we lead the industry in terms of our costs. There's very low fees. We're very strict about disclosures of fees and transaction costs. There are no hidden fees. There are no hidden transaction costs. And maybe not an environment that you'll be too familiar with, but when you pitch to various retirement funds, the consultants, that's a big consideration of theirs, where they want to stack up your transaction costs, stack up your fees, and I'm confident that we always come out on top.
So it's kind of in the DNA at the whole Purple
Yeah.
Group, isn't it? It's
Yes,
you
that's
guys are a
correct.
low cost producer, and for a retail investor, then say that person who's 30 years old, who's making their R1,000 a month contribution to their own savings pot through Easy Equities, they might be putting R500 or could be putting R500 or even R200. What's your minimum that they can put into
Yeah.
the retirement savings, that umbrella fund that you spoke of?
Yeah. So, I mean, if you are sort of a small-sized employer, it's generally enough to join the umbrella fund. But for individuals that are saving in their own capacity, you can always save via the Easy Equities platform through the retirement annuity platform into the Rise bundles, which is essentially a replication of our institutional strategies on the Easy Equities platform.
Because
And there's
Dwayne, this
no
is
there's no investment minimums for that.
okay, because this is quite important. A lot of people nowadays are in the gig economy. They are doing their own thing, working from home. They don't have an employer. They've got the control over their own time, but they would feel maybe excluded from big company benefits like retirement schemes. And what you're telling me now is that that's possible to have that benefit, but not actually work for anyone.
Yes, that's correct. And again, that's the DNA of Easy Equities, and being able to make institutional products, and even the stockbroking market. It was reserved for high net worth individuals for a long time, and they've done a great job democratizing that to the ordinary South African. And really, the vision around Rise is to do the same for institutional savings or for retirement savings.
What happens if your income is lumpy? So you might not be paid in a couple of months. With a retirement fund, certainly my perception is you've got to put away a certain amount every month.
Yeah. So look, I'm not too clear on the exact workings of the contributions. Obviously, there tends to be two models for contributing to your retirement annuity. Either you have a regular deduction from your salary, or you can have a lump sum payment. And I'm not sure exactly what the minimums are for both, but
Okay, but
especially for the lump sum.
I think you've clarified it for us. We've been talking about the product itself, but what about how's it been doing? You say you're in the amongst the top performers in the country, but investment markets have been difficult over the past
Yeah,
year. How you, as the chief
no, it's been
investment
tough.
officer, how have you been managing things to achieve that?
Yeah. So I alluded to it earlier that we're in the business of sort of de-risking our portfolios when market risks increase. We're not in the business of speculating and chasing returns. It's all about de-risking portfolios when it makes sense. And I think, if I had to just take a step back and describe the environment, we sort of if you go back, unfortunately, to 2020, I know people don't like talking about 2020, but it's a very important market event. And so, as we went into the lockdowns, we had a tremendous amount of stimulus coming from developed market governments. So that's fiscal stimulus and monetary stimulus. Just taking the US, for example, they had a $5 trillion spending package, and the Federal Reserve had another 5 billion rand quantitative easing program. So they just pumped a lot of money into the system to keep the economy afloat. And then, sort of what happened is through 2021, as economies were opening, they didn't really take their foot off the gas. And they thought, okay, let's just kind of push this a bit longer to make sure the economy recovers. And then, we were hit by two massive shocks. The first was Russia's invasion of Ukraine, and the second was just China and how they've been behaving. They went from being very supportive of the private sector to just completely turning on the private sector, turning on the property developers and the large tech platforms, and then they just went into this weird phase of locking down cities, manufacturing cities, port cities, every time there was a few cases of COVID discovered. And so that kind of put us into an environment where growth just slowed down dramatically, and at the same time inflation sped up dramatically because what happened in Russia, what happened in China, it affected supply chains, it affected the price of fuel, and that's very inflationary. So central banks were forced to reduce stimulus, raise interest rates, and then you've got this environment of high interest rates, high inflation, low growth, sort of a stagflation environment, and markets just crumbled under that pressure. And I think we did quite well to identify those trends quite early in 2022. And so, we de-risked our portfolios quite significantly. And what I mean by that is we sort of reduced our equity exposure. We shifted to more defensive sectors, more defensive managers. We started focusing more on fixed income and having a preference for local assets over global. And that's essentially, in that sort of environment, we were well positioned.
So, what about the future?
So, unfortunately, say very unfortunately, it's a bit more of the same. I know we saw a bit of a relief rally from October last year to January, and a lot of people were sort of having hopes and expectations that that things are turning. But the reality is that it's just more of the same. You still got an environment where the Fed is hiking rates aggressively. In fact, just yesterday they came out and said that after 2 months of poor inflation prints, they would actually have to raise rates more aggressively and possibly faster. And so you've got, inflation is still a problem. Interest rates are increasing even faster. Still got a very unsupportive global environment. And then on top of that, there's the prospect of a US recession towards the end of the year. So I think a US recession is quite likely. Just intuitively, the Fed is on the second most aggressive rate hiking cycle in history. And almost every recession's been predated by an aggressive rate hiking cycle. Then on top of that, we have numerous other indicators such as the inverted yield curve, there's sentiment indicators, other sort of economic activity indicators which have proven to be good predictors of recession. So, I mean, we think a US recession is quite likely, possibly towards the end of the year or early 2024. So, not in great environment for risk.
So, what you're doing then, if I understand correctly, if you're an Easy Equities client and you're putting some money into the retirement, into RISE, into the retirement investment and savings for everyone, just to give it its full name, you know that money that goes there is going to be kept in a low risk portfolio for
Very
now.
conservative position for now.
Very conservative. You're not taking any chances, and perhaps waiting a little bit longer to see things improve before you move to a higher risk option.
Yes, that's correct. I think in that when that US recession materializes, or when markets finally start to price that in, we'll be in a similar sort of situation that we were in COVID, where there was just a indiscriminate sell-off of risk assets. And if you are there, if you're present, if you have good implementation lines, you can pick up some good bargains quite quickly. I don't know. I'm sure you recall, South African banks were trading 20% down. Is good value. So we are sort of holding a lot of cash and positioned in more defensive sectors. And the idea is that we'll just be patient until we get the opportunities.
Duane Gilbert is the Chief Investment Officer for Retirement Investment and Savings for Everyone, RISE, which is a subsidiary of Easy Equities. And I'm Alec Hogg from BizNews.com.